What is a stock split? A stock split is a corporate action where a company divides its existing shares into multiple shares. Think of it as taking one stock certificate and dividing it into multiple pieces. In a stock split, the original share divides, but the total value remains unchanged. While the number of shares outstanding increases after a split, the total dollar value of all shares remains the same because the split does not add any real value. Let's look at a concrete example of a 2-for-1 stock split. Before the split, an investor might own 100 shares priced at $50 each for a total value of $5,000. After a 2-for-1 split, the same investor now owns 200 shares, but each share is worth only $25. The total value remains unchanged at $5,000. Let's recap the key points about stock splits. Stock splits increase the number of shares outstanding while decreasing the price per share proportionally. The total market capitalization of the company remains unchanged, and no real value is added or lost in the process. Understanding stock splits is fundamental to grasping how companies manage their share structure. Companies split their stock for several strategic reasons. Let's explore why this financial decision makes sense. When a company's share price rises significantly, it can become too expensive for retail investors. A high share price can create a psychological barrier to entry. By splitting the stock, companies lower the price per share without changing the company's overall value, making shares more accessible to a wider range of investors. Lower share prices typically lead to increased liquidity and higher trading volumes. This creates a more efficient market for the company's shares. After a stock split, companies often see daily trading volumes increase by 30 to 100% as more investors can afford to buy round lots of 100 shares. Many prominent companies have conducted stock splits to maintain accessible share prices after periods of significant appreciation. Apple has split its stock 5 times since going public. Tesla executed a 5-for-1 split in 2020 after its shares exceeded $2,000. And Amazon conducted a 20-for-1 split in 2022, its first in over 2 decades. Ultimately, stock splits make shares more accessible without changing the fundamental value of a company or an investor's proportional ownership. Common stock split ratios vary in how they divide existing shares. The most common ratio is a 2-for-1 split. For every share a stockholder owns, they receive an additional share. This doubles the number of shares, while the price per share is cut in half. In a 3-for-1 split, shareholders receive 3 shares for every one they currently own. This triples the share count, while the price per share is reduced to 1/3 of its original value. A 3-for-2 split is less common, but still regularly used. For every 2 shares owned, shareholders receive 1 additional share. This increases the share count by 50% while reducing the price per share by 1/3. Less common ratios include 4-for-1, 5-for-1, and even 10-for-1 splits. These higher split ratios are typically used for stocks that have appreciated significantly in price. To summarize, stock splits come in various ratios, with 2-for-1, 3-for-1, and 3-for-2 being the most common. Higher ratios are used when stock prices have risen substantially over time. The mathematics of stock splits follows a simple principle. The market capitalization of a company remains unchanged. Market capitalization is calculated by multiplying the number of shares outstanding by the price per share. Let's examine a company with 10 million shares, each priced at $100. This gives the company a market capitalization of $1 billion. When the company performs a 2-for-1 stock split, the number of shares doubles to 20 million. Simultaneously, the price per share is cut in half to $50. Notice that the market capitalization remains unchanged at $1 billion. Let's see what this means for an individual investor. If you owned 100 shares before the split, each worth $100, After the split, you would own 200 shares, each worth $50. Notice that the total value of your investment remains exactly the same, $10,000. The fundamental mathematics of stock splits is simple. More shares at a lower price equals the same total value. In summary, stock splits change the number of shares and price, but leave the company's market cap and your investment value unchanged. Section 5. Impact on shareholders. When a company performs a stock split, existing shareholders experience a value-neutral event. Let's look at a concrete example. If you owned 100 shares, worth $50 each before a split, your total investment value is $5,000. After a 2-for-1 stock split, you would own 200 shares, but each share would now be worth $25. The total value remains exactly the same, $5,000. This makes a stock split a value-neutral event for shareholders. However, stock splits do provide shareholders with increased flexibility in managing their portfolio. With more shares at a lower price, investors gain greater flexibility in selling portions of their holdings. Before the split, selling 10 shares would mean liquidating 10% of your position. After the split, you could sell just 10 shares and only liquidate 5% of your position. Another important aspect for shareholders is how dividends are affected by stock splits. Dividends per share are adjusted proportionally to maintain the same total dividend payment. For example, if you received a 50-cent dividend per share before a 2-for-1 split, you would receive a 25-cent dividend per share after the split. The total dividend payment remains unchanged at $50. In summary, while stock splits don't change the fundamental value of your investment, they do provide benefits in terms of trading flexibility and maintain the proportional dividend payments. While a regular stock split increases the number of shares and decreases the price, a reverse stock split does the opposite. In a standard 2-for-1 stock split, each share divides into 2, effectively doubling the number of shares while halving the price. Conversely, in a reverse split, like a 1-for-10 ratio, shareholders receive fewer shares at a higher price. 10 shares would consolidate into just 1. Companies typically implement reverse splits for 3 main reasons. First, they're used to increase share price when it has fallen significantly, improving market perception of the company. Second, many stock exchanges require listed companies to maintain a minimum share price, often between $1 and $5. A reverse split can help a company remain listed. Finally, companies use reverse splits to avoid being classified as penny stocks, which can limit institutional investment and increase volatility. Here's a visualization of how a reverse split helps a company meet exchange listing requirements. A company with a share price of 50 cents would be below the minimum threshold. After a 1-for-10 reverse split, the share price increases to $5, safely above the exchange's minimum requirement, allowing the company to maintain its listing. Market reaction to stock splits is an important factor for investors to understand. Although stock splits don't change a company's fundamental value, markets often react positively to split announcements. Let's examine how stock prices typically react when a split is announced. We typically see a gradual rise before the announcement, followed by a steeper increase after the announcement and through the split date. Studies show stocks often experience a short-term price increase following split announcements. There are several key reasons why markets typically react positively to stock splits. First, stock splits signal management confidence in future growth. They also increase accessibility for retail investors who may have been priced out. The psychological pricing effect makes the stock appear more affordable. Finally, increased liquidity often follows as more investors can trade the stock. Let's visualize how stock splits increase accessibility for investors. Before a split at $400 per share, only investors with substantial capital can afford to buy the stock. After a 4-to-1 split at $100 per share, many more investors can participate in trading the stock. Let's review some research findings on market reactions to stock splits. Studies show an average 3.38% price increase within 3 days of a split announcement. Approximately 79% of stocks show positive returns after split announcements. Trading volume typically increases by an average of 94% after the split. Understanding market reactions to stock splits can help investors better interpret these corporate actions. The stock split process follows a structured timeline with several key dates. Let's explore the 5 critical milestones in a stock split process. First, the company's board of directors meets to approve the stock split and determine the split ratio. Next, the company publicly announces the split, informing shareholders and the market of the upcoming changes. The record date is when the company determines which shareholders are eligible to receive the additional shares from the split. On the X date, the stock begins trading at its new split-adjusted price. For example, in a 2-for-1 split, a $200 stock would now trade at $100. Finally, on the distribution date, the new shares are issued and delivered to shareholders' accounts, completing the stock split process. The entire stock split process typically takes between 2 to 4 weeks from the announcement to the final distribution of shares. Let's examine the tax implications of stock splits. Stock splits are not considered taxable events in most jurisdictions, including the United States. This means shareholders don't need to report stock splits on their tax returns when they occur. However, the cost basis per share must be adjusted to reflect the split. For example, if you originally purchased shares at $100 each before a 2-for-1 split, after the split, your cost basis becomes $50 per share. This adjustment is critical for calculating capital gains when you eventually sell the shares. Let's see how this works with a complete example. First, you purchase 10 shares at $100 each for a total of $1,000. The company does a 2-for-1 split, and you now own 20 shares. Your cost basis is adjusted to $50 per share, but your total investment remains $1,000. Later, you sell all 20 shares at $75 each, receiving $1,500. Your capital gain is $500, the difference between your sale proceeds and your original investment. Remember, while stock splits themselves aren't taxable events, they do affect your future tax calculations when you sell your shares. Many successful companies have implemented stock splits throughout their history. Let's examine some famous examples. Apple has split its stock 5 times since going public in 1980. Their splits occurred in 1987, 2000, 2005, 2014, and most recently a 4-for-1 split in 2020. For their 2020 split, Apple's stock price went from nearly $500 to about $125 after the 4-for-1 split. Tesla has conducted 2 significant stock splits in recent years. First, a 5-for-1 split in August 2020, when their stock price had surged above $2,200. Then in August 2022, Tesla completed a 3-for-1 split, making their shares more accessible to employees and retail investors. Amazon completed a dramatic 20-for-1 stock split in June 2022, its first in over 20 years. Prior to this, Amazon had 3 splits in the late 1990s. With their share price exceeding $3,000 before the split, Amazon's 20-for-1 split dramatically improved affordability for retail investors while maintaining their total market capitalization. All of these examples demonstrate how stock splits make popular stocks more accessible to retail investors while preserving the company's overall market capitalization.